So where did you grow up?
So believe it or not, Josh and I are both from Merrick.
Okay.
He's older than I am, but there was not a lot of overlap. He's like 7 years older than me. So we lived across the street from each other for like a week when I was like 8 years old before I moved out.
That's so funny.
So yeah, we grew up at the same time.
And how did you get into this business?
I met Josh at a train station. He saved my life. I was really This was like 2000 and when I met him, 2008. And I was an asshole in college. So I got
what does that even mean?
I got kicked out of Indiana University
Who
twice.
isn't?
But I got kicked out twice. I was like real bad. Did not take school seriously. And so when I graduated during the crisis, I was like, oh, this is why people go to class. Like, why didn't anybody ever tell me that? I'm like sort of kidding, but not. Like I was really.
And was it just that it took you a while to understand why you needed it? Or just
I was arrogant.
Okay.
Because I always did well in my tests.
All right.
That I always thought I would be fine. And it turns out like that's not real life.
Right.
You know? So spoiler, it wasn't fine.
Right.
Until I met him.
So you met him.
Yeah.
But were you interested in finance?
Oh,
yeah.
Yeah. But it was 2008. And like, who the is hiring an idiot? You know? Like, I didn't have any skills.
Well, back then, a lot, actually. 2008.
But after the wheels fell off, there was, it was over.
Right. Yeah.
So.
I only go to Spanish barbers.
What?
Yeah. Because they don't want to talk to me.
Oh,
they only
that's
talk.
genius.
They talk to each other.
Oh, that's
they
genius.
are carrying on like these raucous conversations.
Yeah.
They're laughing. They're gesticulating.
What did I miss?
And I close my eyes.
I feel like I entered the halfway.
So you don't understand this because you don't get haircuts. I'm talking to Robert. Look at his head of hair.
It's impressive.
This is a man that knows about.
No, but I don't know the most important thing.
I used to go to hairdressers when I had a lot of hair. 10 years ago, I had hair down to my shoulders. And then I transitioned to barbers because it's almost a joke at this point.
Yeah.
And then the problem with barbers is they're really friendly, more friendly than hairdressers. Yeah. And they do small talk. That's like part of their, and there's nothing wrong with that. There are some people that love that.
Right.
They like really love to just talk, hear themselves talk, give and take. I hate it more than anything not because I'm like too good to talk to anyone. I'm not good at it. And I'm like, have my topics that I'm interested in. And I don't want to do weather. I don't want to do politics. I don't want to do Yankees. So I realized is that Michael with hair? It wasn't even good then, by the way.
I had great hair. I really did.
You know, you look like, who's the guy that is doing the new White Lotus, is doing all the promos?
Mike Judge?
Is that who it is?
Mike White. Mike White.
Yeah.
No, Mike Judge is Beavis and Butthead. I'll take Mike White.
So I had this epiphany. I started going to 7 Stars Barbers in Belmore, New York, and they don't talk to me. They're not interested in doing small talk with me.
Right.
It's not English isn't their first language, and they have each other.
Yeah,
and whatever they're talking about amongst each other.
I would
is way
think a
more
guy like
interesting.
you would be like, once you get the barber indicator of what they're buying or selling, then it's time. I think you would be like that guy. It used to be like the shoe shine indicator, but nobody does that anymore.
You know what? Not anecdotally. I guess I'm interested if somebody does a survey, but the one-on-one stock talk.
Yeah.
Oh, and by the way, and you probably get this, there's an expectation if they know who I am or if they know who you are.
Yeah.
What stock should I buy?
Yeah.
What's going to happen with interest rates?
I was with him at a high school game,
and I don't know
and
anything.
the ref came up to me talking about like his
See,
stocks.
I don't get stock things. I get two things. I have a cool Ferrari. You should come film it. I'm like,
Right,
wow,
for you.
you're the only guy that's got a Ferrari. or they have like some problem like, dude, you wouldn't believe what housekeepers in Palm Beach are getting right now. It's awful. You got to do a story on it. I actually did a story on it.
Oh my God.
Actually, you know what's funny about that
It's
story?
so hard to find good help these days. That's the story
It
you
is.
did?
So I did that story. It was the first time I used OpenAI for a headline. So it was a story about how, and this is true actually. I was like, well, that's bullshit. I found out it was true that housekeepers in Palm Beach, because of all the wealth migration, if you were experienced, 150, some were getting 200 plus benefits, you travel. all
Per
this-
hour? What?
Right.
No,
150
for the year.
per year.
Oh, a salary. They're a salary
they're
employee
salary
of the
employed.
household.
That's right.
Oh, that's next level shit.
Yeah. So I actually, for that article, I just got an OpenAI. I was like, give me a good headline for an article about housekeepers in Palm Beach making more. And the headline came up, genius, cleaning up.
Oh.
That's right.
I could never have thought of that.
Which LLM?
I used OpenAI.
That's
Now
right.
I use Claude more. I haven't used DeepSeek much. My daughters love DeepSeek. but
Why do you
I-
use Claude?
Claude, I find, is good with like deeper research stuff. Like, give me the correlation between the art market and the stock market over the past 30 years.
Okay.
It's faster and better with that.
Huh.
Better
I wonder
with
why.
charts. I don't know. It's just my older daughter is studying AI policy.
Okay.
And so whenever there's like, I have an AI question, she's
Yeah.
like, oh, use Claude for this, use OpenAI for this, use DeepSeek for this. So,
Oh, that's interesting.
Yeah.
Do you know about the Claude boys?
No.
You don't know about this?
Jean-Claude, and who's the other one?
No, this is like a real thing. There's like this group of boys who walk around with Claude open on their phones all the time.
Yeah.
And they ask it what to do, and they will only like make a decision if Claude says to do it.
But you can't just ask it what to do. Like, you mean,
No, it's like a
I'm
thing.
here to store, I'm interested in getting brownies.
Yeah, which
should I
color?
get the brownies
What
or should
color? Yeah. Dude, they love Claude. Like
it's very
it has
fast.
the most personable. It has the most personable user interface, which is kind of
That's
sort
true.
of why I think it's like that.
It's also so damn quick. It's just like terrifying how quick it is.
Yeah.
So
Are you going to be a Claude boy?
I don't know. I'm going to check it out. I don't
So
know.
Robert, how did you get the beat covering wealth? I know I just met you, but like, did you grow
Yeah.
up in this world? Like,
Not at all. So I grew up, my parents were hippie artists. I grew up in the Hudson Valley. So my dad was literally like a starving artist. We had no money. And so the family I grew up in, the main value was creativity. Can you see and discover things that no one else is seeing, or see things in a different way? And money was just, it wasn't that we disliked people with money. It just wasn't a value in my family. I grew up with artists, with writers, with painters, so the arts were really important. Music.
and people with money were assholes growing up.
No, they were people that supported the arts. So we knew that they were like, they provided a positive for my dad and his friends. They were the guys at the galleries buying the artwork. So it wasn't like we hated them.
Unnecessary evil.
They were, yeah,
I'm just kidding.
exactly. No, that's probably right. My point is, like, I didn't grow up with a strong view one way or the other. It just wasn't in my value system. But I was very, look, I grew up in the 80s, so we all, the yuppies, we all sort of grew up with a very positive view of success, making money. It's different from this younger generation today, which has a probably more skeptical, broader view of wealth and inequality.
Do we really think, though? So I think they appreciate wealth, but I think they place a higher amount of cultural cachet on people who have won it versus earned it.
Wait, what do you mean by that?
People that have figured out a loophole
I
or a
agree with
hack
that.
or a bet, or they risked everything. Like even the streamers, like the biggest entertainers for people, let's say between the ages of like 14 and 29, right? So I guess that's Gen Z, sort of.
Yeah,
or 27.
Yeah.
So they appreciate people who are gambling 24/7, playing video games for money, finding loopholes that enable them to like pull a hack,
beating the
crypto,
system, beating the system.
That's right.
And it's so funny you mentioned that, because I've been thinking a lot. At CNBC.com, we have this Make It section, which is hugely popular, and most of the Make It articles are like, this 26-year-old is getting passive income and living in Mexico because he bought this vending machine company or something. When we were growing up, certainly,
but it's a trick.
It's a trick. It's a hack. It's beating the system.
That's right.
And they're all about people retiring or making passive income at the age of 25 or 30.
Like being done with having to listen to anyone.
Being done with have to work.
Yeah.
Even like, so which I can't imagine growing up wanting to not work.
Right.
That my goal was not like, I wanted to find work that I loved, that was stimulating, that had a connection to what I was good at, that would help, somehow communicate to others, maybe change the world, probably not. But the idea that my goal was to sit in Mexico and collect money from vending machines.
Do they grow out of that mentality? Or
it's totally, I don't know what. So, but it's also like there's more fondness for even criminals that have beat the system.
Right.
Like
100%.
they respect people who, I won't name names, but that have been arrested and charged, and they love these people.
Yeah. No, it's no shit. It's not a
It's like what you said about Wolf of Wall Street. Like, let's talk about the victims of these crimes. Like Leo DiCaprio, just like Wall Street, the movie, like Gordon Gekko was not, Oliver Stone, as you said, was not supposed to be a hero.
He was an inspiration.
He became the same thing. Liar's Poker was the same way. But I think this generation takes it to an extreme where they actually respect and admire people who break the law, who find a way to get back at the institutions, the man, whether it's the government or Wall Street or banks, and find their own way of doing it.
I wonder if that's immaturity or that's just internet culture, and it was like always trending in that direction. And then I remember seeing an Instagram post where Drake met Jordan Belfort, and Drake was like, it was like a big deal to Drake. It's like, wait a minute, didn't you just spend the last 20 years like performing and acting and touring the world, and you're excited to meet this fucking guy?
But what about hard work and all that it brings? Not just that it's actually a more realistic way to get sustainable wealth and become really wealthy, but what it gives you in preparation once you get that wealth.
But the internet did that. The internet did that.
But they're not clicking on that. They're clicking on the shit. They're clicking on things about generational wealth.
Yes.
Like they're more, it's so crazy. You have 19-year-olds.
So this word,
they're
generational
poor,
wealth.
But they want generational wealth.
All of a sudden I hear all these athletes talk about generational wealth. I'm like, dude, if you can even make it to retirement without going bankrupt, good for you.
So I think this is internet culture. It's feeding them all of these stories, and some of them are real, about people who have tricked the system or found a workaround.
Yeah.
And that exists. You think about people buying Bitcoin at $50 per coin, they'll never work again. No. It's all real.
Yeah.
But like those are the heroes.
Yeah.
And I don't know that that's permanent because the Gen Zs will turn 30 one day. And they will have lost a lot of money in scams along the way. And they'll realize, oh, that's not how you do it.
Well, one of the things I always tell people that surprises them is, they say like, well, how do most people get rich? And they think it's celebrities. They think it's rock stars. They think it's somebody who traded crypto. Because that's kind of what they see on Instagram.
That's what's in their face.
It's the guy you've never heard of who built a packaging business or built a real estate business in Nashville all his life. Maybe his dad started it. He inherited a small stump of a business and grew it out. And you own a private company. How do you get rich? You start a private company, you build it,
sell it.
Here's the key. Exactly.
I'll give you
You sell it. And it's just like, but that formula is gone. Yeah.
I'll give you a guy I'll give you a guy. This is a guy, Adam Weitzman. This should be the guy that Gen Z emulates. He's our age, or he's older than us. This is a guy that had a garbage collecting business, like scrap metal.
I love that.
In Syracuse, but he's the most lit. He is the most lit person I've ever seen.
That's awesome.
On Instagram. All his friends are rappers and basketball players and celebrities. He's like a big donor to Syracuse.
Did he inherit it though? I guarantee his dad.
I think he went to prison or something.
Awesome.
So this is like the perfect role model. Awesome. No, but if you follow this guy and his family on Instagram, this is real wealth.
Yeah.
This is like a business that's not glamorous at all. But 100%. He turned it into glamour to the point where he's like at every restaurant opening. Like that's who Gen Z should emulate. It's like
totally.
This guy has a business that he spent 30 years to build. It only looks like overnight.
You're going to have him on ownership? You
Maybe.
should.
He'd be awesome. I don't know how to get to these people.
Good? Let's go.
I'm not as good at you at getting to these people.
All right, coming in with 3 claps.
All right. This is so exciting.
Clocks.
Hey, throw these on.
He's not going to. He has like a glasses thing.
Okay.
You're good. You're good.
I'm good.
The Call of My Friends, episode 178.
Today's show is brought to you by Kelly Intelligence. Duncan, did you see this article in the Wall Street Journal the other day? I'll tell you. Don't worry about it. Here's the headline. The Magnificent Seven are sold last year. Cash cows are the new kings. All right, so what's a cash cow? A cash cow is a company that is it's gushing cash. There is so much free cash flow, you wouldn't even believe it. And that is what the Kelly U.S. Cash Flow Dividend Leaders Index is trying to accomplish, trying to get you access and exposure to companies that are hemorrhaging cash. HCAT tracks this index and also sells calls on the constituents. It's got a 98.6% active share against this S&P 500. What does that mean? Don't worry about it. Here's what it means. Very diversified, not a ton of overlap. It's not just the Mag 7. These are cash gushers. To learn more, visit kellyintel.com.
Welcome to the very best podcast in all of financial media. I say that, I hesitate to say it. I feel bad having to repeat it, but I listen to other shows and it's so much mid. And it's nobody's fault. This is not easy to do. We have an incredible staff. Nicole is here today. Daniel is here. John is here. The founding father of this channel, Duncan. Duncan is, don't shake your head. You know what you've done.
Do you have to have a beard to be on that side
Duncan's
of the
our
camera?
Ben Franklin.
Look what you've done. All right. You guys, I'm so excited for today's show. We cleaned the studio up extra nice because our special guest is a fastidious man. I think I have to right?
Pretentious, probably.
He didn't
More
know
like
you grew up as a hippie.
No. Well, now I know the real story.
Exactly.
All right. Robert Frank is an award-winning journalist and best-selling author. He joined CNBC in May of 2012 as wealth editor. Prior to CNBC, Robert spent 18 years as a reporter at the Wall Street Journal. That's where I first started reading your stuff. What was your original beat when you were writing
So I
the
started
journal?
Journal in 1994, and my original beat was air cargo. I was covering FedEx and UPS down in Atlanta. And then I started covering Coke and Pepsi. Then I went to London and covered Eastern Europe, and they sent me wherever there was trouble. I covered the Northern Ireland peace process.
Oh, wow.
I covered the embassy bombings in Africa. And then in 1997, when there was the Southeast Asian currency crisis, the Thai baht was devalued. They're like, Southeast Asia is a shit show. We need somebody there. I was about to come back to New York. So in 1998, I went to Southeast Asia. I was covering the Philippines, Indonesia, was going through all these upheavals. So I was like, that was real foreign correspondent land where I'm in kind of at that point, dodgy situations, covering 14 countries. I loved it. Came back to the US and I was on the M&A beat. Now remember at the time, this was in 2000, 2001. The M&A beat after Steve Lippin and Nick Diogen was the premier beat in financial journalism, let alone the Wall Street Journal. It was the hyper-competitive. You were competing against.
Wait, Diogen came from the M&A beat at the Journal?
Yep.
Wow.
Diogen,
Oh, I didn't
Diogen and
know
I
that.
started the same month in Atlanta together. So we go way back.
Nick Diogen was running CNBC when I first
That's right.
when I first started appearing there. Okay.
Yeah. And so I started covering mergers and acquisitions, and I was competing against Andrew Ross Sorkin at the New York Times and David Faber at CNBC. It's tough. It's tough.
Okay.
But I loved it because I got to understand how Wall Street works. Because you're dealing with investment bankers, but you really want to understand the whole ecosystem of Wall Street. So that's kind of really
That was the LBO era of M&A.
There was a lot of LBO, a lot of club deals and private equity. I mean, there wasn't much because it was right after the .com bust. But yeah, exactly right. So then I just said, look, I'll do this for 3 years. I finished. I was doing my last story for M&A was a compensation story, and I got this chart on how many Americans were worth 5 million, 10 million, and I just got the research because I was interested in like where Wall Street guys stacked up, right? And I was like, holy shit. The numbers of people worth 5 million, 10 million, 100 million, they had all doubled in 7 years. And look, we all know that there was wealth created. We all know that there was like coming back to the US after being overseas for 7 years, I just saw how much wealth there was all of a sudden.
Yeah.
And so I was like, I went to my editors and I said, give me 1 year, I want to start covering wealth. And they're like, what?
What do you mean by wealth?
What do you mean by wealth? Don't we already cover like
Right.
making money? There's Forbes. I'm like, no. I'm going to go at this to try to figure out where the wealth and how the wealth is being created. Who are the new wealthy? What does that economy look like that's growing up around them? Because we're talking
The services economy.
So you were covering the people behind the companies.
Exactly.
Right.
And so my first article was in 2004, and I went down to the Fort Lauderdale Yacht Show, and the goal was to show how yachts had gotten so much bigger so quickly. And I was down there sweating in my suit for 3 days. It was 90 degrees. No one would talk to me. That's the other thing about this beat. Like for years, no one would talk to me. Like, hi, you're rich. Can I talk to you about your money? Yeah, sure.
It used to be taboo.
Yeah. And,
Well, have you seen that kid that walks around with the little microphone?
I was like,
now they're all talking.
I didn't know why I didn't think of that. I was genius, that guy.
Yeah.
What do you do for a living? I mean, that's...
Well, because he's in a t-shirt.
I know.
And he's disarming. He doesn't have a camera crew.
I know. I got to change my clothes, get rid of the cameras, and be younger. Be 30 years younger. That would
Some
help.
of those guys say no at first, and he persists.
Yeah.
And he gets them
he's
to
very
talk.
good. He's a genius. So I finally got him to, like, he had a 100-foot boat. And he's like, you know what? Like, when I got this boat, this guy from Cincinnati started on his boat. He's like, when I got this boat, it was like I was special. And now he's like, look, and literally next door, and there was a 250-foot boat. Paul Allen was building his 400-foot boat.
Yeah.
And he's like, it's like a dinghy. And so he said, it's almost like a whole other country, a separate country.
Yeah.
I was like, ding, ding, ding. Like, the rich have created their own country. In terms of the economics, in terms of what's a priority to them.
Well, it's called Southern Florida.
Yeah, it's that, and it's New York, and it's Aspen, and it's the Hamptons, and it's all these places. But they have become a virtual country. And so the way I started the beat was I loved being a foreign correspondent, but I didn't like traveling anymore. I was exhausted. So it's like I could look at wealth, I could cover it like a foreign country, but not have to travel out of the country. So my whole concept for covering wealth and naming Richestan, which is the name of my first book, was it's a foreign country, and I should cover it just like I did Albania or Thailand.
Yeah, here are their
Indonesia.
customs.
Exactly.
Here's their language.
Get the maps, get the language, and
Right.
explain it to people who don't live there. That was the goal.
So, Robert, I was talking with Ben on the pod this week. Like, when you think rich, do you have like a dollar amount?
Yeah,
Or is
10
it
million.
Like, okay,
10
that's
million.
it? Okay.
Yeah.
10 million liquid or just net
10
worth?
million investable assets.
Investable
Yeah,
assets,
because
okay.
I mean, yeah, if you own a private company and if you sold it's worth 10 million, your lifestyle is probably not
You're probably
$10 million.
you're probably pulling
10
the
million
money out,
liquid.
enough
Now,
money
I
out.
probably have to change that. I probably should update it to 30 million because just in terms of numbers since when I started, there are now around 450,000 people in the world worth 30 million or more.
That sounds insane.
Yeah.
around the world, but that's 7 billion people.
I know, but
It's
that's-
not
No,
that
but
many.
in
That's
the
a lot
US,
of
in the
people.
US, it's about 240,000.
That's insane to me.
240,000 people.
Of a population of
240,000 people worth 30 million or more. So I should probably, the way I look at it is I cover the ecosystem or the economy around the wealthy. That's wealth management, it's philanthropy, it's the art market, the car market,
Private jets.
it's all that stuff. It's insurance, it's luxury real estate, and really the people that are in that world buying a Ferrari, buying a penthouse, buying these, really a private bank client of JP Morgan, it's really 10 million, 10, probably more like 25. So I should probably update that. I should inflation adjust that.
Let's not bury the lead here because you've launched something new, and I'm really excited about this. CNBC's wealth editor and best-selling author of Richestan, A Journey Through the American Wealth Boom, will expand his efforts to report on the booming business of family offices and high net worth individuals. And so you've got this thing, Inside Wealth newsletter, and you're going to be going, it sounds like, deeper and wider. And then CNBC notes the population of the ultra wealthy, 30 million or more, has surged 50% over the past 5 years. And the number of family offices has tripled. So it's trillions of dollars. Everybody wants to do business with these people. Everybody wants to be in their orbit or marry somebody in their orbit. And you note as over 100 trillion gets passed down to heirs as part of the great wealth transfer, Inside Wealth will chronicle how the next generation and women are changing the landscape of wealth and philanthropy. So there's a lot going on. How are people going to receive your stuff? It's an email?
Yeah.
Or it's a regular letter?
Yeah, and let me tell you what the idea behind it was. So, I've been at CNBC for 12 years, and a lot of what I do two things. When I came to CNBC, I was like, look, I'm not going to become a TV person. I have no aspiration of being an anchor, of being a TV person. I'm a reporter and writer that appears on TV once in a while, probably less than you do. But so I've always been writing, and I've always been covering wealth stuff, because CNBC is mainly a stock investing channel. Now, I cover the luxury companies, so I cover LVMH and Hermes and Richemont and Kering and all that stuff. I cover Ferrari, which is now a publicly traded company. I cover, things that Sotheby's used to be public. I do cover high-end real estate because real estate is interesting. But I have this whole other kind of life online. What we decided to do in the last year was to really become more essential to the audience that I have, which is a very special audience. I mean, having covered this for 20 years, Forbes is kind of falling apart. The Wall Street Journal covers wealth occasionally, but it's not packaged or delivered or covered in a predictable way where you're like, okay, every week or every day I'm going to get something about what the wealthy are doing with their money.
They'll do like a trend feature,
yeah, but it's like
not their bread and
occasional.
butter.
It's occasional.
Yeah.
Same thing with the FT. Same thing with Bloomberg. Like they all kind of cover it, and they would say they cover it. And Bloomberg,
Rob Report.
Rob Report also the five best beaches. You know, I'm not the five best beaches.
That's
thing.
right.
Do you know who your audience is? Like,
yes.
Is it aspirational wealth or is it the wealthy?
So it's the wealthy.
It's Barry Ritholtz.
Oh, interesting.
It's so I was actually surprised at how many of the wealthy love comparing themselves and finding out. Number one, what I do is like I cover the art market. I cover these markets that they're in and they're interested in, and their friends are always talking about it. So like the $6 million banana, like what the hell was that? Was about? I explain it and I explain what's happening in the art market, the recession in the art market, watches, cars. So the wealthy like to watch me because at CNBC we cover the spectrum of money from the bottom to the top. I'm the top. What we decided to do was say, look, how can we have a very special audience. It is the wealthy, but more importantly, it's people that serve the wealthy. It's wealth managers, it's family offices, it's multifamily offices, it's people in philanthropy. When Richest became a bestseller, this is before we had like good internet data and ebooks. I was like, who is buying this book and why? Because it was like, it blew up and publisher was like, it's so well written. I was like, no, it's not because with all due respect, it's not because I was telling
You didn't write Bonfire with the Vanities.
No, absolutely not.
Right.
Although that is one of the great books of all time.
About wealth.
Maybe even
sure.
the greatest, but maybe next to Gatsby, maybe those two are the greatest books about wealth, fiction-wise.
Yeah, I think so.
So when I went out and started talking to people, getting emails, it was mostly wealth management people. And they're like, you taught me about the clients I don't have. You're showing me the clients. I know my own clients, but you were telling me where wealth is being created that I'm not seeing, the types of people that I'm not reaching.
How they make decisions.
How they make
what
their life is like. So I was like, holy shit, this is actually useful to somebody. So fast forward almost 20 years, and now because my content is actually useful to people, any company in the world that either wants a high net worth client or has high net worth clients wants to know what the wealthy are doing with their money.
So this is a good segue to what you're writing about, which is the explosion of family offices. Because back in the day, these ultra rich individuals would work with like the private bank or maybe the advisor, and now they're just doing their own thing.
Why do you think that's happening, both of you? Because I have my theories, but I'm curious from your perspective.
Why are people hiring their own in-house CFO?
Instead of saying F you to the system.
I think first of all, they could afford to.
Well, I think there's a vanity factor is number one. Number two, their kids are less and less useful. So they need somebody.
Their kids are less useful.
Listen, they're doing bill pay for the grandkids. Like they're paying car leases.
Yeah.
There are adults in this country who have never they have never lifted a finger for themselves and can't do anything.
Yeah, that's
so
true.
part of the family office is not like, oh, we're going to pick better ETFs than JP Morgan.
Right.
The family offices will wipe your ass.
Well,
so there's an element to that.
Also, they don't want to be captive, right? To
Yeah.
just be beholden to one bank's products.
Yep.
What do you think? You sound like you have a great reason.
No, I think all of that is absolutely true. I think the growth in wealth, I think the amount of responsibilities that they have
Complexity.
for a growing family. I think what I'm told from family office. Now, I wrote my first family office article was in 2005, and it was about how family offices, to your point, had become a status symbol. It's like, I got a family office. And the investment part of it was sort of secondary to the fact that you had this private company that handled all your shit, like whether it was the private jet fleet or the kids' school or like whatever. Right. What I think happened was after the financial crisis, a lot of wealthy people were like, I just got hosed by my private bank. My advisor really didn't have my back. Whether it's Morgan Stanley, Goldman Sachs, like they really screwed me. I need my own person that actually understands this stuff. I was at a meeting
that only works for me.
Truly represents my interests.
But don't you see how good or how bad that could be?
For who?
For the buyer.
For the family off. For the
why?
family.
If you have your own quarterback, why is that bad?
I know a lot about this world.
So tell me.
Okay.
Tell the audience.
I know a lot about this world. There are incredible family offices, like where they recruit top-notch talent, people coming out of Goldman and great banks that are doing such high-end work that the client says, how much do I have to pay you for you to not deal with anyone else? Just come work for me.
Yeah.
That's the dream scenario. And that exists.
Yep.
And there are really impressive people in the family office world. That's like for billionaire families. Then there's this sort of like next layer where it's a family office and they're like almost duplicating an investment bank.
Right.
It's like, oh, we have somebody here that does M&A. Why?
Right.
We have someone here that does stock picking, CFA,
right?
Who's like meeting with companies and listening to conference calls.
So we have
a venture person? We have this, we have that. So I met the family office people, and they're very serious, and I'm sure they do a great job. They work
the family office people.
They work for I'm talking about a specific group. This is hilarious to me. They work for one of the biggest retailer families, but it's like the fourth generation,
right? And
they no longer own this storied like department store chain.
And it's not Walmart.
No, not quite.
Yeah,
that's billionaire.
Yeah.
So they have this whole office set up, and they're like explaining how they're different from an RIA. And I'm listening, and I'm like, all right, I sort of understand it. So you guys aren't like a fee, like an AUM fee, like we are. He's like, no. What we do is we come up with the budget of what it's going to cost us to run this family office each December for the next year.
Yeah.
And we calculate the salaries of the people and the equipment and the travel and all this stuff.
Yeah.
And I'm like, so what does that work out to? He's like, that's like 1%.
Right.
But so my point is, I think the faster growing trend in family office.
Yeah, but what's the incentive for him versus the products?
Well, here's the problem. Here's where I've seen it go really wrong. You have somebody in your life that knows everything about you.
Yeah.
You become wholly dependent. Your whole family becomes dependent on this person.
Yeah.
And they're also involved in your investments. And let's say they're only really good at moving money between banks and answering your phone, but they're not good at the investment part.
Yeah.
So now you're going to hire another person,
right?
Or you're going to have that person oversee these people.
Yeah.
You almost can't get rid of this person from your life.
Yeah.
And I've seen this too.
Yeah.
And a lot of very wealthy families are saying, hold on, we got wealthy because we wanted to maintain independence. Why do we want to have W-2 employees again?
Right.
Like what? Why do we want to build the structure that now relies on us? That sounds like going in the wrong direction.
Right.
And so what I wanted to tell you, multifamily office, I think, is the real trend that will emerge from this.
And define that.
Well, we're running a version of it. A lot of RIAs are.
What is it?
A multifamily office is we are not we're your family office, but we're also the family office for 10 other families. We're going to take the knowledge that we learned from working with all of you and wield it on your behalf. And you don't have to go to sleep at night thinking that we're a wholly dependent employee of yours. Right. Like if you go away, we'll be upset, but we're not your subsidiary.
Yeah.
Like we'll be fine one way or the other.
Right.
And I think that's liberating for a wealthy family to not be in this situation.
If you can truly deliver the product. Sure, and secondly, if you can truly prove to them that you have their interests. And we should also tell people, just like if people think, oh, family office, this is some obscure tiny corner. There are 8,000 family offices, 8,000 family offices now
Solos
managing
or total
single family offices.
Wow.
8,000. That has more than doubled over the past 10 years. They're managing $3 trillion
John,
right
we have
now.
that chart. Let's put that up.
Managing $3 trillion now. That is expected.
Is this what you're referencing?
Yeah, there we go.
Okay.
So that's going to grow to 10,700. Now, if you look at the dollars actually next to that, the dollars grow even further. So right now, there's estimates that they manage somewhere. The AUM for them is around $3 to $4 trillion. Going to go to at least $5 trillion. So I know people often say, well, they manage as much or will manage more than hedge funds. Now, a lot of them invest in hedge funds, so that's like double counting.
It's the same money.
Some of it's the same money. But if you look at what they're investing in startups, we now have a deal tracker where we look at family offices and what startups people, the big ones like Bernard Arnault family office, Jeff Bezos. So we had some great stories looking at what AI startups have Jeff Bezos, Eric Schmidt, Bernard Arnault invested in over the past year. And so you can look at all those companies. Eric Schmidt's invested in 22 private AI companies. So they are becoming a force. Now, they're not doing leverage buyouts yet. The big trend is toward direct deals, direct private equity, as you know, alternatives. So private credit, they're less interested in private credit now than they were 3 years ago because the returns are crap and the product is not as good. But they are becoming a bigger force just because, again, it's somewhere around 3 to 4 trillion in assets and will grow over time.
Well,
so it's a pretty serious
There are
player.
some sports owners with their own family office, and it's a necessity, I think. If you're a wealthy family and part of your wealth and part of your life is spent owning a sports franchise, there's so much peripheral business around that franchise that you need people in-house that work directly for you and not for the team.
Right.
But like, these are my people that keep track of my share of what's coming from the team. That has to be a family office. There is no organization that's set up to service you.
That's right.
But I know some of these guys, and they are doing M&A with their own private money because they love. If you got rich making deals, why would you want to spend your time as a rich person not doing deals and being on the sideline?
Well, and if you made your money in the restaurant business or in the retail business, you know it. And so you go find a private company, you invest. Not only are you giving capital that's very patient, much more patient. Private equity, we want out in 7 years. Family offices are like, we want 20 years.
Yeah.
But I'll also help you because I started a successful retail company or food company or whatever. And so you get the patient capital and you get the management expertise. And the challenge, to your point, is they don't have the due diligence capabilities that a lot of the IBs have when they're doing these deals. So and the big thing now is club deals. So, it's club deal is like, you have 3 buddies that all have family offices at the golf club. You're like, hey, a guy has a building in Boca, and where is it going to become a new distribution center or whatever?
You and Firm Mill?
You form an LLC, and you
go in
do the
together,
deal.
and because it's like, oh, it's my friend. They're all doing this. I just don't know how that's going to work out over time.
They don't care though. Because this is the part you're leaving out. They probably can't do the same level of due diligence, but if you have a B,
they don't care.
Who gives a shit?
Yeah, they don't care.
This worked, that worked.
Yeah, that's true.
Who are you measuring yourself against?
That's true.
So is there a level of wealth at which you think the single family office makes sense? Because if you're a billionaire and you're traveling and you've you need your bills paid, you need your travel coordinated, you need all your cash flows and this and that.
The cutoff used to be 100 million when I started covering it. Now I think it could go 2 ways. Some people say the cutoff is now lower because technology allows you to do so much automated now that you don't need a full staff. So there's some people that say you could actually do it for less than 100, but then it's machines and then it's like, what are you really getting? I think it's more like 150 to 2 where, that 1% that you'd be paying someone else starts to make sense. It's like, okay, that's $2 million you're spending on a family. What kind of talent can you really get for a staff with $2 million?
Yeah.
So I think it's really like 150 to 2, but 100 million is what most people will say is the cutoff.
More interesting to me is where is the line where RIAs can't encroach? So will RIAs get involved in travel agency-like activities? Probably not.
No.
Maybe that's the line. Will RIAs get involved in selecting a physician?
Or insurance solutions?
Well,
insurance,
so insurance, yes, but it's
But the concierge services, we can't do that.
No, but you can have somebody who knows how to do that. And you can have a network. You can have a network of like solutions that are just for this group. And I'm curious to you guys, one thing I can't figure out is if you had a pie chart of who manages the money for people worth 10 million or more.
Advisors.
Yeah.
Percentages, like go through, what do you think it is for private banks, the wirehouses, the RIAs versus family? Like, what do you think that looks like and how is it changing? I can't figure out, are the private banks losing share to IRAs? Are they IRA roll-ups like really capturing
to a
share?
certain level? So I think 25 million and up, the wirehouses are in really great shape.
Okay.
Because there's a lot of lending and a lot of money movement involved. 25 million and up, number one. And number two, the source of wealth for that cohort is probably related to investment banking activity. It's probably either M&A or an IPO. That's how you get to 25 million.
Yeah, totally.
Okay, so the wirehouses are in really great shape there. They have a lot of these businesses that cater to companies that have just gone public and, we'll refer you to our wealth guy and our so they're really, really good at that. 10 million to 25 million is an RIA business.
Yeah.
I think unquestionably we're better at the wirehouses there because our pricing is more transparent. We're not selling them bullshit. We're not selling them the fourth best private equity fund because we have access to it.
Yeah.
I think we win there. 10 million and under is a real knife fight because then it's like Ameriprise and like insurance companies. Right. It's the private bank at JP Morgan. And JP Morgan has 5 different private banks.
What you just described, though, is exactly why I get calls from people who've just had a liquidity event. They sold something for, it could be 300 million, it could be 30 million. And they look at this landscape and they've spent their whole life just living their business. You got to be obsessive just about your business. All of a sudden, you've got this liquidity and they're like, I don't know what the hell to do. I've got 5 different kinds of companies all telling me they have holistic solutions to my entire wealth management and planning. My family, multi-generational, they all say they have
it. Same buzzwords.
It's the same buzzwords, but to really figure out who delivers, you have to become a client first, and then it's too late. So,
no, you have to ask
what
how
we just
do they
talked
get paid?
about is like people think, it's a great problem to have, but when you focused your life on building wealth in a business, and then all of a sudden you have to invest it, people screw up because it's so hard.
It's hard, and at that level, you can't ask your friend for a referral. Hey, who's managing your 300 million?
You have to. The first question is what are the incentives? If you're facing
exactly.
If you're facing 5 different people who are all saying we're going to do generational wealth transfer, we're going to do taxes, we're going to do insurance solutions, we're going to do holistic whatever. Okay, how do you get paid? And if the answer is, well, it's complicated, and then somebody's like, you're the only person who pays me. That, like, for me, and that's why we set up the business the way that we did.
Right.
For me, if you can look someone in the eye and say, you're my only payer.
Yeah.
I can't get paid by anyone.
Yeah.
I can't send your money somewhere for a rebate.
And then explain to them what your incentives for getting paid
are.
And that helps too. Yeah.
Of course.
Yeah.
Let's talk about the wealth effect.
So Robert, Josh is a big wealth effect guy.
Okay.
And
I think it explains everything.
Okay.
Truther.
I think that the level of spending has less to do necessarily with the value of real estate or what your cash is paying or what your 401k is. I think it's the economy, which is maybe sort of saying the same thing, but it's like if Americans have a job, they will spend all their money.
Yeah.
I think it's as simple as that.
Going back to richest 10, there are 2 economies, or probably like 5, but to Josh's point, and I was a believer. I continue to be.
He's only allowed to know about the first 2.
Yeah.
What's the third? I wasn't listening.
There are 5 economies. I'll tell you about 2 of them.
Yeah. I've written about the wealth effect. I believe in it, but I believe in it because it relates to the people I cover. Now, most Americans get their wealth and their consumer confidence from 2 things: their income and their house. Mostly their income. Until you get to the top like 10%, that's where asset values and the stock market start. Now, the reason the wealth effect is probably more pronounced today than it has been in the past is because the wealthy account for the top 10%, as you've reported and repeated, own about 87% of the stocks.
It's a K-shaped economy.
It's a K-shaped.
Did you notice any pullback in 2022 of these mega wealthy spending?
100%.
Really? Okay.
Okay.
So
I'll
give
give
me
you
more.
some examples. The art market went into a recession.
In 22.
In 22.
Because the NASDAQ
It was
fell.
a little bit delayed. It was a little bit delayed because the big art sales are planned 6 months in advance. But it started to happen in the back half of 22 and certainly happened in 23. Classic car market, the art market.
Rolexes.
The Rolexes crashed in price. Yep. And now some people in the watch market was highly correlated to crypto.
Mm-hmm.
A lot of the guys in watches were crypto. So that was kind of related, but that's what happened there. The art market was interesting. Partly because it wasn't so much that the stock market, because the stock market did so well in 23, I was like, what the hell? That doesn't make any sense. It was because interest rates were so high, the opportunity cost of then buying a painting versus putting it in 5% risk-free was competition.
Yeah.
But what happened in 2022 is all these collectibles markets went into the tank. Now, real estate was very location-specific, but real estate started to suffer a little bit as well at the very high end. Look, I always say it's for the wealthy, it's not about the money, it's the mood. They always have the money.
The desire to spend it is
it's
different.
The confidence that is highly correlated. So when I worked at the Wall Street Journal, they were like, okay, you're going to cover, where do you want to sit? I said, I want to sit where I always sat, in the money and investing section, in the markets groups, because the markets group is where my people, it's how they feel every day, because they're so tied to the stock market. Even if they have a private company, they're going to look at the values of similar companies or their investments. So I think that the wealth
you want
effect,
to be right next to Jason Zweig.
Exactly.
And write
Jason's
about
awesome.
Lamborghinis.
He's the best. He's the best. He thought I was hilarious. He's great. I love the show you did with him. But
absolutely.
But so I think the wealth effect is important for the most important group of consumers and investors right now. The top 20% account for over half the spending. That's probably even more true today with inflation than it was before. But if you look at, there is no such thing as the economy, which is why, and one of the reasons I started Inside Wealth is because it's irrelevant what the economy is doing.
Do you think there used to be an economy?
More of it, yeah. In the 50s and 60s, there was certainly, we all rose together.
Yeah. Less stratified.
We all rose together. And
I agree with you.
But so if the rich people pull back spending, does the economy even feel it? Or is it like segmented to their richest stand or wherever?
What's the general economy more correlated to, the bottom or the top?
Bottom.
It's more correlated to the bottom right now. But there are certain parts of the economy that are correlated to the top.
But these things can't exist independent of each other. In other words, you're not getting rising wages at the bottom,
for instance,
unless the wealthy are spending money.
Right. That's right. Now, look, we say the wealthy. The wealthy are
Super
spending
wealthy.
at Costco, right? We know that Costco and Walmart, too, they're getting a higher share. So it's not just that LVMH or Hermes are the measure of what's happening. The wealthy spend in lots of different ways, and it's going to take a horrific situation if the wealthy stop spending at Costco and Walmart. So I think they spend all along the chain, but just in terms of raw numbers, and the marginal propensity to spend, which is the idea that when each dollar that comes into the wealthy, more of that is saved by the wealthy than the rest of Americans that spend it because they have to. So I think because of that, it's felt less.
It's weird. They're like sucking money out of the economy.
They are sucking out of the money. And I have a grand theory, Josh. I'm curious, as more and more wealth is concentrated at the top and just has to go somewhere, is that one reason why markets are so stubborn to go down? And look,
I think I espoused the theory 11 years ago called the relentless bid. And the general idea was that financial advisors create financial plans. And the more equity risk your clients take, the higher the likelihood that your clients are going to hit their targets. And you know that because of a Monte Carlo simulation. And as we started to disincentivize stock trading by getting rid of commissions for retail brokers, so we disincentivized transactional business, and we emphasized more long-term, more ETF allocation. So advisors would build these financial models for their clients, and when the market's down 5%, it's like, oh my God, if I rebalance now, buy my clients more stocks, look how much better the plan looks.
Yeah.
It's like pulling the lever.
I see.
We do it faster and faster now because we all know what our clients really need, given the longevity of rich people. When you hear the actuarial tables, you're going to live till 72. Yeah, probably not if you're a client of Morgan Stanley. If you're a client of Morgan Stanley, you live to 100.
Yeah.
So you need more stock.
Yeah.
The only answer to every question is more stock.
More stock. Yeah.
Okay.
Yeah.
For people who are already wealthy and they already have.
Well,
that
and I also
lifestyle.
think it's important. You
So
go
that's
back to inequality. And
source.
in your book, you talked about like the way to fight back on AI is to invest in AI companies.
No choice.
I've had the idea of like the new pitchfork is the brokerage account. Put down your pitchfork and open a stock account and buy stocks.
Robinhood blew up.
Because the way you're not going to hedge your life entirely, no matter what occupation. But unless you're wealthy, the best way to not ever get on that boat, or at least to try to balance some of it, is to buy stocks.
I think that message is hitting because Robinhood's latest quarter,
young people get that.
The account funded blew up. They're getting a lot more people as customers.
The earnings were just
know
bananas.
that folk story about John Henry. So he takes on a steam shovel, and at the time, steam powered equipment was like the bête noire of the working class. And it was like, oh my God, look at this machine. It used to be 500 men with shovels tunneling through the side of a mountain for a train track. And now there's just this steam-powered engine that's going to shovel. And I don't think that the Gen Zs would lionize John Henry in that scenario. They'd be like, what a dumb
Right.
What they should have done was invest in their
Yeah.
own steam shovel
Right.
and had a more powerful, better technology.
Yeah.
Like, so I think the kids understand that
Yeah.
concept
And let me give
now.
you some numbers to prove it. So, we don't really realize how much wealth was created since the pandemic. It's like, okay, we all know that there was a ton of wealth, ton of liquidity flooding the system, both from fiscal and from the Fed. So from COVID to now, the top 1% total wealth went from 30 trillion to 49 trillion. That's a gain of
4 years.
63% in 4 years.
Right.
That's more than a decade of wealth creation that just happened it was really in 3 years because you take the market out in 2022. The top 10% went from 70 trillion to 107 trillion. So they added 37 trillion in wealth.
Most of
up
that is
50%.
Elon, though, in fairness.
Most of it is Elon, exactly. So let's just look at okay, well, what was driving all that wealth creation?
Real estate.
AOI.
It's almost all stocks.
All stocks.
Yeah. Real estate doesn't appreciate that fast.
The stock wealth of the top 1% went from 12 trillion to 24 trillion.
Yep.
Just in those 4 years. And
Found the bubble.
And the top 10% went from 19 to 43. So the wealthy got a lot wealthier. I mean, everyone did well, but the wealthy got wealthier faster because of stocks.
You know what's crazy? 15 years ago, the most likely way to become a financial celebrity was to be one of these guys telling you not to invest.
And
It's
do
true.
what?
It's true.
And do what?
Go on Twitter and tell everyone the next 2008 crash is coming any minute.
Yeah.
That was how you built renown,
Yeah.
is to call crashes and look at everything and say it's a bubble,
The Rubini
and
effect,
teach retail know-nothings how to quote-unquote hedge their portfolio.
Al Teacher had an article, "Don't invest in your 401k," that went mega viral.
Yeah.
It was like a big deal.
So
at the time.
15 years
that,
ago,
yeah.
like if you wanted to make a name for yourself in the financial media, the fastest route to doing that was to talk people out of long-term investments. And of course, that proved to be disastrous to anyone that heard that siren call.
Just wait.
Can we talk about this New York Magazine
I
article?
love this. I love this. Yeah,
So
this is awesome.
This hit this week, and a lot of people were talking about it, and I thought it was a pretty well-done article. Although I sent it to my wife, and she goes, "This is nothing new."
Here's the lead. New York has always been stuffed with rich kids chasing the dream on daddy's dime. However, it didn't always feel as if those were the only people who could live here. As if the whole city bent to the budgets of the secretly funded. It does feel that way now because we're living through a catalytic overlap. Rent prices are shooting up, salaries are not, and boomers are prepared to die. I agree with Josh. This is not new.
But wait, finish this though. It wasn't always this way. They quote a realtor who says in 1989, a one-bedroom on the Upper West Side was $63,000, like to purchase, not to rent.
Yeah.
The equivalent of about $157,000 in today's dollars. A similar unit in that building sold recently for $730,000. Some of this, Robert, is a story of New York just being a way better place to live now than it was in the 80s, the crack smoking 80s.
Yeah.
Like there's a gentrification angle to that in a good way, like less crime. And then some of that is just an explosion in wealth.
Yeah.
And the boomers wanting to watch their children spend it, not leave it to them when they're dead.
Yeah. So that article reminded me, the Franny Leibowitz line was like, nobody can afford to live in New York, yet 8 million people do. How do we do it? We do not know.
Yeah.
But it's also what—
But you live in Manhattan. This must have hit home for you.
It did, because when you go downtown and you see all these 20, 30-somethings in cafes in the middle of a workday.
Living in the West
Village. You're like, how are they doing this?
Well, that's no mystery.
And that you're right. That hasn't happened, but because real estate everywhere has gotten so expensive, but particularly in New York, where a studio apartment's $1.5 million.
Brooklyn's $1 million.
Yeah,
you can't buy anything in Brooklyn for under $1 million.
So I think it grates people who are struggling to rent here. Now, 2/3 of apartments in Manhattan are rents, not buying, and very few first-time buyers are buyers in Manhattan. Most of them are second, third-time buyers moving up.
If you walk into Via Carota and look around on a Tuesday, everyone in there looks like an Abercrombie model.
Yeah, but
those are the rich those are the children
Some of
the
them,
wealthiest people around the country.
So let's widen the lens and talk about the great wealth transfer, because this is the most important thing that I've been covering once we started Inside Wealth, and it will be, I think, the main issue. So over the next, let's say 30 years, around 100 to 130 trillion dollars will be passed down from baby boomers to the kids. So where will that go? The first transfers, what we're seeing now, and by the way, I was extremely skeptical of all these numbers for years because I'm like, baby boomers are the ultimate hedonists. They're gonna burn the shit out of their fortune and like party up in Ibiza and everywhere else.
It's too much money to spend. They
Or
can't spend
they're
it all.
old now.
And they're not gonna leave anything because they want to enjoy it. So, but what private bankers are seeing is that it is happening. They're already seeing it happening. So over 100 trillion. So the first will be the spouses. So the wives will get it because rich guys marry younger women. Women live longer than men anyway. And so the spouses are going to get it first. The second group that's going to get it is Gen X. So if you're a wealth management firm, the people you want to target right now
That's
is
who
Gen
should
X.
get it.
Gen X, absolutely.
Sorry.
Gen X is going to...
We're the last generation that knows what to do with money. These people have no taste. Otherwise, it's incredible.
They're going to get $39 trillion. Gen X is going to get $39 trillion.
You feel better now? You're going to get 39 trillion.
Fine.
Millennials are going to get...
Reality still bites.
Then slacker. Then millennials are going to get 40. Millennials will be the richest generation when it comes to these great wealth transfers. Now, here's the other thing about millennials. This goes back to this whole issue of rich kids.
Yeah, but when we're 60.
You could wait.
30 years. Yeah, it'll take a while.
I think
the
boomer, the millennials
So
have
the
done
average
enough
billionaire
damage.
is 69 years old. Like,
Nice.
this money is going to start flowing pretty quickly. But here's the thing. If you look at millennials as a whole, they are not as well off as baby boomers were at the same age of 35, right? I think it's like 30% less than
Because of
boomers
cost
were.
of living.
Well, even if you adjust everything, they just, salaries, et cetera, cost of living is exactly. But if you take the top 10% of millennials compared to the top 10% of baby boomers,
The
at
super
same-
millennials.
the super millennials. Now,
Yeah.
not everyone you see who looks like Abercrombie and Fitch models is a rich kid. They've got good jobs on Wall Street. They're analysts. They've got good jobs in media. They've good jobs at a tech startup or a tech company. So there is this section of millennials and Gen Z that has very high paying jobs. So not everyone that we see that's under 30 or under 40
They're not idle.
is
They're not all idle.
They've got very highly skilled jobs that pay a lot of money. So that's number one. But there is this inequality now within millennials that the wealth gap within millennials between the top and the bottom is the widest of any generation.
Oh, that's interesting.
So one of the reasons I think millennials have a jaundiced view of wealth and resent it is because they see more inherited wealth in their generation than we saw when we were growing up. So when we were growing up,
that's true?
you had like the rarefied Astors and Hearsts and like Vanderbilts, but there weren't that many as a proportion of the overall billionaire population. Inherited wealth was not a factor after the late 1980s, early 90s. It was almost all 85% of millionaires were self-made after the 1990s. Now, what I think is going to start happening, and what's already happening, is millennials see more of their own peers inheriting wealth and getting wealth. So that's going to change your entire view of the wealthy. Because if it's the Lucky Sperm Club versus somebody who worked their ass off for 50 years, of course you're going to hate rich people.
Does this partly explain Gen Z's unexpected move toward Trump in this last election? Are enough of them? Are there enough Gen Z people who are either currently wealthy or aspirationally wealthy that they said this Kamala message doesn't resonate with me at all?
I think what we feel like as a culture, I think there's less of an idea that the way to reduce inequality is to make the rich poor. I think everyone agrees that what we really need to do is help those at the bottom. So I think the idea of like,
That sounds inflationary.
Get the rich guy.
Well, if there's nobody to do the jobs that no one wants, if everyone's rich, it doesn't work.
The idea of like, get the rich guy. Oh, and also there's some, I think there was a perceived risk that everyone's taxes would go up under her. So I think on the economic, aside from inflation, I think was the main thing that drove people. But I think that's.
Let's do these charts.
Yeah.
Just getting back to the original part of the article, which is like, how are these people affording these $5,500 rents. So we made some charts on New York City housing,
Oh, I love
both for
this.
the sales price
Oh, that's
as well
great.
as rentals. And this actually shocked me. We're looking at the median sales price.
Shout out to Chart Kid Matt, by the way.
And
That's
it's gone sideways in Manhattan for the last 10 years. Really,
Yeah.
prices haven't gone anywhere. Where prices really exploded for sale were Brooklyn, right? Like that story is well known. The orange line. Brooklyn prices are up 128% since 2010. But here's the thing that's really pissing people off. It's the rentals. Okay.
Right. Yeah.
Next chart, please. Look at this.
Yeah.
So the price to rent in Manhattan is $4,365. That's the median.
Yeah, the average is
the
over
median.
5,000. The average is over 5,000. Yeah,
So
that's
this
nuts.
is the chart that's destroying people.
Yeah, and 2/3 of all apartments are rentals. That's what's killing people.
So when these people know that their friends are being backstopped, how could it not lead to resentment?
It does. It
How could it
absolutely
not?
does. It does. And I've been talking to brokers recently, and a lot of brokers I talked to recently said almost every deal they're doing now involves a trust.
the parents.
a trust
fund.
trust.
And
They've
the
got
article
it.
made it sound like these people, they feel shame. And it's not that they did anything wrong,
Yeah.
but it does suck to know that I'm only buying this because my parents and my friends are it's a tricky situation.
Yeah. I knew people, Josh, you probably both know people when we started coming to New York City, and we all knew people that, had parents help, whether it's their rent or whatever. But I do think
You didn't
it's
have to, though. You
yeah,
didn't
that's
have
right.
to.
That's right. Because that's right.
My first apartment was on East 77th Street. I lived down the street from the Coconut Grill, if you remember.
Yeah.
I had Brother Jimmy's around the corner. Nobody had any money on my block. These were like 5-story, I don't want to call it townhouse, would be to romanticize. These were walk-ups. But like you could I think my rent was $1,100 a month.
Probably
and
$7,000.
I was like a loser stockbroker.
That same place is probably $10,000 now.
But I could afford it. Yeah, if it hasn't been bought by somebody who just turned it into something
So
magnificent.
my first lease was in Astoria, and it was a big apartment. It was $2,000, and that's probably $5,000 right now.
Right.
And that's what's different. Now, it's very difficult to picture somebody moving to Manhattan without 2 roommates, unless the parents are helping them.
Yeah.
And that's an interesting point that you bring up, which is that the inequality within millennials now trumps the millennial versus boomer shit that we've just lived through. That's over
The new
now.
generational warfare is within millennials, and it'd probably be true for Gen Z as well. I don't know. Millennials had it rough because they came in during the financial crisis. They came to financial age.
Yeah.
They've got student
started
debt.
investing late.
They got student debt. They don't own houses. They're not forming families, which sort of helps generate wealth when you're dual income. So they have all that against them. Gen Z probably came up in with all this liquidity, so they'll have it better. But I do think the millennial stuff is going to be a big source of tension, and I think it's going to, I wouldn't say radicalize, but it certainly helps explain why there's a more negative view of wealth among millennials than there were like baby boomers or even Gen Xers.
Let's do this Disney thing. Annual vacation budgets.
Oh yeah,
Robert, you saw this article in the Journal?
I did. Yeah.
All right, so this is, let me set it up and then you could tell us what's going on. Even Disney is worried about the high cost of a Disney vacation, and we have a chart for this.
So they made a great chart in the Journal showing the income quintile from the bottom 20 to the top 20 and the annual vacation budget. And for the people in the middle and the fourth, fifth, it's impossible. The entire annual vacation budget is blown out by Disney. Even for the top 20%, it becomes unaffordable.
Yeah.
So there was apparently a hack. I don't remember this, but the Genie Pass, the Genie Plus passes, over the last 3 years, from October 21 to June 24, generated $724 million in revenue for Disney.
Yeah.
So, Disney has
Genie
become
Plus cut all the lines.
Yeah, but if you look at, so when I talk about the economy around the wealthy, we aren't talking about this tiny slice of people that's only like X number of millionaires. If you look at the boom in private clubs right now, almost every part of our economy now has a VIP version, right? In some ways, inside wealth at CNBC, if you look at CNBC, we're kind of the Mercedes of financial news.
You are that.
But I'm like the AMG, which is like the next level up.
Yeah.
And so I think what the Disney thing reflects is that the wealthy aren't just getting wealthier. There are more of them. And more of the economy is sort of roping off an even special version for the wealthy. The other thing that's happening is, and everyone thought this was going to start happening 10 years ago. It's really happening now for the first time. the experience economy, travel, dining, food, that's where the wealthy are spending their money.
Oh, yeah.
Yeah, they're buying stuff. They're still buying stuff. They still like their cars.
The
There's both
experience.
but what is, and this is why LVMH went into the luxury lifestyle business with buying a hotel chain. They're sort of putting restaurants in their stores now. The Tiffany, the biggest success in that new Tiffany store is the Blue Box Cafe. So they're creating these experiences, part museum, part food and dining, where they know, they've seen that the wealthy, what they really love is not more stuff. And I think that's true up and down generations.
It's exclusive experiences.
They want experience. They want great food. They want great wine. They want great visuals.
Robert, technology is enabling this, though. Disney's got so many different ways to give them money now.
Yeah.
You think about the concert experience. Bruce Springsteen, the working class troubadour that he is, decided that he wanted to do demand-based pricing.
Yeah.
And he gets to hide behind Live Nation, of course, so
Right.
nobody thinks it's him.
Yeah.
But like the price of a Bruce Springsteen ticket is whatever price the buyers stop buying at.
Right.
That's
Wow.
where and that's where it is. And like
There's no limit.
but back in the day, Bruce Springsteen in the 70s and the 80s and the 90s, they would print the tickets on paper. The price was the price.
Yeah.
You might have had 3 zones, 100 section, 200 section, 3. Now it's this technological advancement where the price will go wherever the next person is willing to take it. And Taylor, of course, was able to do that.
Yeah.
I think that pisses people off too.
Yeah.
When they're just like, wait, I don't understand. Why am I priced out of everything?
Yeah.
Because the technology is enabling it.
Well, and there are just so many rich people now.
Well, you
And
can't get to restaurants anymore.
You can't. And that's why. So one thing I couldn't figure out private clubs, and there's at least a dozen new private clubs in New York that open. It's Zero Bond, it's Casa Cipriani.
That's pure status,
It's-
though. The private.
No, it's so. Why are they paying, X, whether it's $10,000 a year or $1,500 a
I
year?
mean, we went to Casa Cipriani last year. It's pretty fucking awesome.
It's beautiful.
Yeah,
it's
but
beautiful.
it's too many
Casa
rules.
Tua on the Upper
It's
East
like
Side.
a strip club. I don't.
No, they changed it. The escorts, they got rid. No, they got rid. There were too many, so they got
I
rid
took
of
a
them.
picture at Casa Cipriani and posted
Yeah,
it.
well,
and
that's bad. You're not supposed to do that.
The person who took me got arrested.
Yeah,
I'm not on any of that shit.
No, but the reason these clubs are popular, and Casa Tua just opened on the Upper East Side. There's already a wait list. Is because you can't get a reservation anywhere else. So all it is so when ZZ started in Miami, and somebody
That's
called me
Major
up,
Food Group.
yeah,
That's
Major Food
Carbone.
Group, exactly, Zalaznik and Carbone, and they do a great job. And they said to me, somebody said to me, oh, they're charging $20,000 just to make a reservation there. I'm like, why would anyone? That's stupid. Well, then they raised it to 30, then they raised it to 40. There's still a waiting list of hundreds of people. The suchi's fine.
Dude, this economy needs to
it's not
crash.
that-
There's
it's
too
not
much
that-
fucking money sloshing around.
You know what you do when you have when you belong to a private restaurant? You spend the whole week calling and trying to get people to go with you.
Yeah.
Like everyone goes with you the first time.
They're
and it's like
when
I ran out of people. I gotta get
but they're
repeats.
always crowded and they're waiting lists, and whether they go or not, these people are making money, and it's just because there are so many people able and willing to pay a fee for not even going.
So this new paradigm.
It's
this,
like
this,
Planet Fitness with an extra $10,000 instead of $10 a month.
Does
So now
this
it's
does this
15.
go into reverse in the event of a recession, or is this just the way it is for
So
now?
the thing about luxury and the spending of the wealthy, going back to it's not the money, it's the mood. I think right now, so there was a burst of spending by the wealthy. You saw it in the luxury companies. You saw it everywhere else in the art market. Right after the election, there was a burst of spending. Private jet companies tell me everyone said the wealthy just like went out and spent. They were selling cars on Bring a Trailer. They were selling $250,000 Porsches on Christmas Eve. And they had never seen that before.
Yeah, yeah.
Remember the excess savings? That story was supposed to be over 3 years ago.
Yeah, I know. Well, but
I know it's different than your people, but
there's more excess and excess savings at the very top. So I think what everyone, it's hard to say the wealthy do anything because it's such a diverse group now. But I do think they're kind of in wait and see mode right now because you've got the tariffs, you've got the inflation interest rate situation, sort of unclear where that's going. And even though there's a lot of euphoria and the animal spirits and all this stuff people talked about after the election, I think the picture is a little more cloudy now. And so I think my sense is there was this burst. Now there's a bit of a pause in the real estate world. The art market might have a good spring. We'll see. So things are better than they were at this time last year. But it would take a major correction in the stock market for any of this
I would
excess
argue
to work
it's
out.
not about the severity of the correction. It's about the duration. We have not had a 12-month downdraft in the market. We had a pretty substantial 8-month
Wait, what?
in
Dude,
2022.
in 2022, it was 2 years before we had new highs.
No, but I'm talking about being down and no recovery.
Right.
Okay, yeah.
Right.
This is different. And I lived through this in the 2000 to 2002 period. It just wore people out.
Yeah.
It wasn't about when do we get back to new highs. It was like, oh my God, I can't take it anymore.
Yeah.
Yeah.
We haven't had that in 20. It's, we really haven't had it since the great financial crisis. I want to do 2 more things with you. The carried interest loophole.
Yeah.
It's a big part of the wealth discussion is like, why do some types of wealthy people have these special deals in the tax code?
Yeah.
Trump, like, out of nowhere, just like randomly blurted out,
Yeah.
we're going to look at the carried interest loophole.
Yeah.
And I think like everyone did like the meme. They did that
Wait,
side eye.
the rich guy with a billionaire cabinet wants to get rid of carried interest.
Wait,
What is going?
what
What's
is
wrong
he
with this
saying?
picture? Yeah.
All right. So for people that
Yeah.
don't know, this is hedge fund, private equity, private credit,
Private venture capital.
venture capital, because they are quote unquote taking risk, LOL. Because they're taking risk, they don't pay taxes as though it's W-2 income. They're being taxed as investors, and it's a favorable tax rate on the gains when they sell a property or or they have a liquidity event or whatever.
Yeah.
And that is obviously how the rich get richer. It's one of the principal vehicles by which we have people. Steve Schwartzman's worth $50 billion.
Yeah.
Okay.
Yeah.
That happens in part because of his investing acumen, but in
Yeah.
part because he doesn't pay taxes as though he earned the money
Right.
working at a law firm.
Right.
Okay, fine.
Yeah.
You love it. You hate it. We're not going to do that today.
Yep.
He said it once.
Yep.
That was it.
Yep.
Nobody argued with him.
Right.
The private equity executives could not be reached for comment
Yeah.
because they know the thing with Trump is never disagree publicly.
Yeah.
Do you think he's going to bring that up again?
So he
Is that
brought
on the
it.
table?
He said it in 2016.
He didn't mean it. He just said it once.
He said it in 2016, and they did actually in the 2017 tax cuts. They extended the years by which you have to hold the investment to get the special capital gains treatment from 1 year to 3 years. So they sort of made it less attractive. Now you're probably going to hold those investments for 3 years anyway as a private equity fund. It's usually like 7 to 10. So fine, didn't matter. But there was something symbolic that they did, so he could say, "See, I promised it. I did something."
Okay.
Biden promised the same thing in 2020. The Democrats said, "No, we're not going to change it." Steve Schwartzman, David Rubenstein, they're very powerful lobbyists, and they've got a lot of money.
Yeah.
So this thing gets killed. I think this time they might be able to get it through because I think it's only going to raise about $1 billion a year by closing it.
It's not actually going to solve any problems.
It's not going to solve any problems.
gonna,
So what does that
quote,
tell
unquote,
me?
level the
That
playing
tells me
field.
that the rich guys have figured out a way around it.
Already.
Already.
What do you think it is?
I think
Caymans?
I think it's offshore. It's a management company that's offshore. That's part of it.
Dubai, something.
No, it's like Caymans or Puerto Rico or whatever. You know,
Jersey.
management- Yeah, that. And it's also somehow using the, it's a pass-through structure and using pass-through the beneficial tax interest and tax treatment of a pass-through versus ordinary income. Somehow using that 20% less that you get through pass-through that way. So I don't know exactly what vehicles are using, but my guess is they've seen this coming. They've got, these tax strategists now in trust and state law, they are geniuses.
Yeah.
And they work faster than the IRS.
They're Navy SEALs.
And
Like
exactly.
So
they have already figured out a way around it. So my guess is because of that, the private. Now we had Joe Lonsdale on recently, who I think voiced support for keeping it and says, look, this is small businesses, this is mom and pops, this is sweat equity, all the reasons they usually give for
There's an
keeping
argument
this.
for like, you don't want to divert people from going into the investment business because they create jobs, but it's like,
Come on.
is that really going to stop people from going
No,
into private
you're-
equity?
It's like, I don't want to make this huge investment and get $1 billion payout because I'm going to have to pay 17% more on my taxes from that. No, it's not going to change any. It doesn't.
Yeah.
But it's a loophole. Now the tax code. So when you think about inequality, it's like, okay, Robert, you've been covering wealth 20 years. How do we solve it? I think when you look at the tax code, and I'm obsessed with taxes. I love the tax code. I think the two things that stand out to me is step up in basis is ridiculous.
Kill that.
Like
So you die, your kids start from scratch with where the price is
what's
now.
the origin of that?
Well, so I don't know. It's a good question. I don't know what the exact origin. I mean, I know what the origin is, but it can't be explained. What it is let's say you start a business, you buy Apple stock, whatever it is, you bought it at $1, it's now worth $1 million. When you die, the basis of that for tax purposes goes to
Today's
$1 million.
price.
So there's zero tax. Suddenly that tax just disappears when you die.
Yeah.
I think that's wrong. I don't know how it ended up exactly in the tax code. I mean, there are some reasons, but in today's capital world, it doesn't make any sense. The other thing I think we should think about is the capital gains tax itself, which is preferred treatment 23.7 instead of 39.6 or 37 plus the 2.3, was based on a time when capital was scarce, when you had to incentivize
that's a good point.
people to invest. We have to otherwise people won't invest. We have a surplus of capital around the world now. Do we really need people? Now, investors are going to kill me for saying this, but I think something we should look at is like, should it be closer? Because I don't think, taxes are designed in some way to incentivize behavior you want and disincentivize behavior you don't want. There's plenty of money in the world. And
they would argue putting money at risk is different than income that you earn in a vocation.
Yeah.
I would argue you have risk either way. But I understand the philosophical idea behind.
Well, also those people who are like, "Why am I giving up more money to the government? I already pay them."
Yeah, but the flip side of that is, Josh,
it?
should work be taxed higher than wealth?
All right, Che Guevara over here.
No,
I don't know the answer.
That's the flip side.
Yeah.
Like, that's the flip
All
side.
right, Jamie Dimon, good or bad?
Awesome.
Yeah, I agree.
And the building is awesome.
That Jamie Dimon is my president.
He's so awesome.
Okay.
And by the way, their private bank is like, I mean, it's the bomb.
Yeah,
it really is.
It's in and of itself, it's a massive sprawling operation.
Yeah, they have this conference every year that I've been dying to go to. They'll never let me in, but it literally is like just billionaires that go. And Jamie,
the one in Miami.
Yeah,
I know somebody that goes to that.
And it's like
I heard it's litty.
When I ask billionaires, like, what's your favorite event of the year? It's like not Davos, it's not Sun Valley.
Yeah.
It's like, it's that, because it's all billionaires and they're all just hanging out and they've got amazing speakers, athletes, celebrities, and it's like that.
Well, the conceit of the event is that there's nobody here that's going to go type this into an internet field.
And more importantly, the wealthy only want to be with people who are as wealthy or wealthier. If you're ever doing a seating chart for dinner and you want like somebody, make sure you seat them next to somebody who's wealthier because they don't want to go to anything unless there's somebody wealthier than them.
Yeah.
And the beauty of that conference is the reason everyone likes it is because billionaires can go and know that there's somebody even wealthier than
There's a multi-billionaire.
Yeah.
Dimon went on quite a screed this week. He's got employees signing a petition against 5-day a week return to office policy. And here, let me read this. During an animated town hall meeting on Wednesdays yesterday, the 68-year-old was questioned on the petition, which has garnered roughly 950 signatures. In a recording reviewed by Reuters, Dimon said, quote, "Don't waste time on it. I don't care how many people sign that fucking petition," end quote. He also said that in-office requirements would not be left up to managers, adding, quote, "There is zero chance I will leave it up to managers. Zero chance. The abuse that took place is extraordinary."
Abuse?
End quote. The abuse of work from home. Yeah, he's got people walking around a shopping mall talking to the customers of the bank. The whole thing is a joke.
No, and I think when in the branch people had to show up every day and then to tell the managers, everyone else, you don't have to do what the branch people had to do.
Yeah. So I have flexible work policies here.
Yeah, but
but if I'm him, I probably wouldn't.
Yeah.
Because I think it's a different kind of organization. That's a bank. I'm not a bank.
Yeah.
And I think he's absolutely right. You don't have to work here.
Yeah. No, I think the whole power shift is happening when we're all waiting for when labor starts to lose some of their power and management starts to get more and they're like, look, when can we finally have enough leverage as management to tell our people we want to get back? And I think Jamie's leading the way on that, and he's being unequivocal. Like, we are a better company. You are better people and employees if you are together during the day and learning from each other.
Do you agree with me in terms of, like, can you imagine the nerve it takes? We're at the threshold of the age of AI, and you're putting your name on a petition for why you shouldn't have to show up at the office.
It's very short-sighted, very dumb. I would not advise that.
Very dumb.
Yeah.
I would not advise signing.
On
this
the other
petition.
hand, you could say, like, it's a reflection of the culture at JP Morgan that people feel like they can voice what they think and feel safe.
He's telling you not
I don't
to
know
bother
that you would
voicing it.
feel that at, like, Meta. Meta,
Yeah.
you'd be out.
Tesla, you'd be out.
Yeah.
Yeah. I think if you're the CEO of the firm, you have to set the tone. You have to say, this is what we do. And then if there are people that work there that don't agree with it, they could say something.
Yeah.
And they could also just quit and go somewhere else.
Right.
And there are plenty of financial services firms you could work at where they don't care where you are.
Yeah.
But that's not one of them.
Yeah.
And that's just like, it's not a democracy. You work at a company. Like, and they're JP Morgan, I would guess, are probably paying above market salaries for most roles within the bank.
Yeah.
And you don't have to have one if you don't want it.
Right.
I know a lot of kids that just graduated school that would kill to go work in an office building filled with coworkers and would love that role.
Yeah.
So I agree with that. All right. Did you have fun on the show today?
It was great. I mean, one last thing. I'm just curious. You guys have a lot of 20, 30 somethings. How do you think the people that you deal with and your audience thinks about wealth? Do they still aspire to have it? And what is their definition of wealth? Do you think both your clients and the people that watch?
That's a great question. So I think a lot of the conversation that we had earlier in the show about how different generations, how Gen Z thinks about wealth, I think a lot of that is online. It's a lot of what you see on the internet. And I don't really believe that the entire generations think so much differently about money than we do.
Because if that were true, Instagram wouldn't exist. Like, Instagram is a lot of it showing watches and cars. And
you look at the funded accounts on Robinhood. People are wise to the fact that equities are how you build wealth. Now, a lot of it is crypto too. But ownership.
But what does wealth mean to them? Like, what is their, like, I don't know. When I was growing up, it was like the nice house, the car, like.
Same thing. Never change.
I mean, right now it feels
Really?
it feels out of reach for a lot of young people, because it is. With 7% mortgages, with prices like this, unfortunately, real estate is not a reality for a lot of people.
Yeah.
But this idea that people are just like full-on nihilists and don't give a shit about anything, I just don't really believe that. I think it's a section of the internet for sure.
Josh, what do you think your view of wealth growing up versus the aspirations when they define wealth with today's?
So I grew up upper middle class, but didn't know it. And the disparity between my own situation and my friends was pretty minor. Thinking back, there's nothing that I was able to do that anyone else I was friends with couldn't do. So I wasn't rich. We didn't do crazy shit.
Yeah.
And we lived in a suburb that was fairly homogenous economically. Like, roughly everyone's parents could sort of do the same thing. I still live in that town today, and it is not that way. So for my kids, they're experiencing the world differently than I did.
Way more.
And my brother's kids, forget about it. He lives in Calabasas. And in Calabasas, they're probably all very similar. But like in the city of Los Angeles, that wealth disparity would be off the charts relative to Long Island. So I do agree with you that the interesting thing now, and probably the biggest area of tension, is intra-generational wealth disparity.
Yeah.
I don't know what you really do about it. And now that I have a college-age kid, like the things that I've seen and heard, you cannot even imagine what goes on in the mentality of the parents. And I guess I think people get serious about wealth when they have kids, because from my perspective, I wanted to be successful. I didn't really care that much about money. And then my kids, no, not really. Not when I was in my 20s. I wanted to have fun.
Yeah.
And then having kids in my 30s. But then in my 40s, when the kids were teenagers and everything started to cost a lot, that's when I became way more driven about, like, how much am I going to pay myself? So I think that that's not uncommon. I think that's most people, frankly. But I do think the disparity, even within suburban communities, within cities, is probably way bigger than it was when you and I were kids.
Yeah.
And I say that as though, are we the same age? I'm not sure.
No, you're younger. You're a lot younger than me. But
I'm a lot younger?
Yeah, I think so, yeah.
But I feel it. Anyway, I want to tell you, you're one of my favorite reporters and writers, truly. And I love that you cover your beat, not without a disdain for people who have succeeded, but also not in a celebratory, masturbatory way. You just tell the stories of the people.
Years ago, I was talking to Sheldon Adelson, the Las Vegas billionaire, and I was telling him what I do. You know, I cover wealth from a financial perspective. He goes, I get it. You're the thinking man's Robin Leach. So that's what I use.
We always end the show with champagne wishes and caviar dreams. We always end the show, Robert, with one thing that you're looking forward to in the future. It could be anything.
Seeing you down at Future Proof.
Look at this.
Right answer.
Can we talk about that for 1 second?
Yeah. I have a great guest down there.
All right, so that's what I want to get to, but I actually have some details on this.
Okay.
All right. So you have a session called Rockstar Energy, Rockstar Wealth, an interview with Russ Savage, which is going to happen at Future Proof Citywide in Miami.
Is that the Trace Comas guy?
Trace Comas. March 18th at 11:25 a.m. to 12 p.m. on the Loomis stage. And you are moderating, and Russ is your guest. And people are really excited about that. I just learned of it today. And there's like a buzz within Future Proof.
So he's awesome. So he's a guy that started Rockstar. His dad is Michael Savage, the famous conservative radio host. And he started Rockstar, sold it to Pepsi for $4.7 billion in 2020.
Amazing.
And I first knew about him because I was at a yacht show and I saw this insane yacht. It had the most insane party amenities of any, and he had Rockstar energy drinks everywhere and it was painted and I was like, this guy is awesome. So now he trades his own stocks.
Oh, I love it.
So what I want to look at is how do you go, that transition, as we talked about, from entrepreneur to investor is very hard. And he's learning the hard way. But I want to talk to him about how he built that business, why he decided to sell it, and how do you make that transition to an investor. And so that's what we're going to talk about. And he's awesome. He's like everything you could imagine.
We're so excited to have you at Future Proof Citywide, and that's definitely gonna be a highlight.
That's great.
So I will be definitely on hand for that. Michael, what are you looking forward to, my friend?
There's a new movie coming out with Tim Robinson and Paul Rudd. It's called by A24. It's called Friendship. Is that the right? Is it called Friendship?
I think so.
I saw the trailer yesterday, and in my mind, I'm like, oh, this looks like Twisted, I Love You, Man. And at the end, the tagline was, it's I Love You, Man, but for sickos. And I said, I'm in. That's me.
awesome.
I got Cable Guy vibes from it.
Yeah.
Right? Remember Cable Guy?
Of course.
Duncan, is that in your oeuvre? Cable Guy?
Jim Carrey, Matthew
It's been
Broderick.
a long time, but yeah,
That was one of the better, to me, that was one of the better Jim Carrey movies.
Before he went crazy.
Yeah.
Well, because it's like male friendships are weird to begin with,
Yeah.
a little.
Yeah.
Unless you made them when you were a kid.
Right.
It's kind of like, what is this really about? Or are
Yeah.
wives friends? Or like,
Are we official?
are we official? That looks like a perfect, like, awkward version of that. I can't wait for it.
Josh, what are you looking forward to?
White Lotus, the press machine has ramped up. There's a New Yorker profile about Mike White, who we talked about a minute ago for some reason. You talk about the wealthy.
Yeah.
That's such a great show from a class warfare standpoint.
100%.
Because you've got the people that work in these resorts and cater to them, even like bartenders, prostitutes, you name it.
Yeah.
And then you've got the patrons who are completely out of their minds.
And they've captured the texture of the wealthy very well in that show. What they read,
better
how
than
they
most,
talk,
right?
Their clothes better than. I mean, to me, Succession is the GOAT when it comes to recent series about the wealthy. I mean, they got it right with that one. But Lotus is very entertaining.
I think Lotus is one of the few shows where they threw out the entire cast, and the show was even better.
Yeah,
and no one was mad about it.
Right.
They had one holdover cast member from season 1 to season 2. Nobody does that.
Yeah.
That's American Horror Story does that. It's an anthology series. No one in television has the balls to say, this was a huge hit. Get rid of all the actors. Get rid of the setting too. We're going to start from scratch. This is one of my favorite things about it. And they have one holdover in this coming season. They brought somebody from the Hawaii cast to Thailand.
The worker.
For season 3.
Yeah.
So, all right, that's it from us, guys. Thank you so much for listening. I want to let people know where they could subscribe to Inside Wealth. How do they find you?
CNBC.com/Inside Wealth.
CNBC.com/Inside Wealth. And Robert, you are active on X.
Yep.
LinkedIn. Instagram.
Some on
Lurking.
Instagram. Mainly LinkedIn. But if they sign up, they get my weekly newsletter.
OnlyFans?
Not yet.
Robert, you didn't.
Thank you guys. You guys are awesome.
We appreciate you so much. Shared so much insight with us. Thank you. Great job to the whole cast and crew. Guys, thanks for all the likes and subscribes. We'll see you soon.